David, great to meet you. Let me give a shout out to Endgame Macro for bringing your account, your handle to my attention, and I'm glad we were able to make this conversation happen so quickly. So thank you.
Well, I'm very excited to be with you and your listeners today to try to give them a framework for understanding a completely different approach to markets and investing. I've been looking at markets, I can't even tell you for how long. It's more than 4 decades. And I started recently a company, QAge, after seeing so much of the information on Twitter and financial media, now X, that I felt lacked a lot of the context that a lot of new investors are experiencing with the bottom of the NASDAQ 100 in October 8th of 2002, and we were up 32 times in price since then. Some people started in 2008, some people started during COVID, but people have only seen a one directional move in technology stocks, a super expansion of innovation valuation. And I feel it's useful. And I am the most optimistic, bullish person you can find in financial media. I have targets on the other side of the winter we're expecting that I want to run through that are far in excess of every single other rational person, both for the NASDAQ, innovation companies, and even for crypto. But there's an inevitable risk of a major deleveraging event happening as we restore pricing derivative structure to a healthy level. And so my background is my first job was for a subsidiary of JP Morgan Chase, then Bear Stearns, and then a subsidiary for Citigroup and Morgan Stanley. I did work for a number of years for Stephen Cohen at SEC Capital doing research and macro. My famous claim to fame is on April 17th, 2001, I spoke about the risk of an emergency rate cut happening on the same day as Cisco earnings because we had that 26% rise in the NASDAQ on January 3rd, 2001 in just 5 minutes. So I thought there was a candidate event and that worked out, saved a lot of risk. But I'm trying to give people a framework, both as just a listener of my podcast, someone who follows me on the X platform, someone who listens to my subscriber only Squawk Box in the morning, where I talk about added additional insights. Um, we're taking advisory clients. I advise a $4 billion fund, and we're considering taking assets for direct management. Um, and so, with that, I'd just like to thank you for having me here and allowing me to get a little broader audience where I can give people just an opportunity to think 1% away, divert 1% of their attention away from an existing framework. And everything they do, they can work with their advisor to incorporate it into their trading decisions.
So let's back up a second. So you talked a little bit about some of your past experiences or companies that you worked for. What were you doing for them? This episode is brought to you by Vaulted, launched by McIlvaney Financial Group, the simplest and most affordable way to own physical gold and silver. Physical gold is the only asset outside of the control of the government and banking system. They can print dollars, but they can't print gold. Click on the promo link in the show notes or go to vaulted.blbvux.net/coffeeandamike.
So I worked
What's your
first.
background, David? What's your background?
So my background is in credit, in forecasting, in fixed income. And then with Steve, I did a global macro as well as it was the start of the basis trade and just putting everything into perspective using the price level, uh, uh, the interaction with the derivatives of volatility and skew and kurtosis, because there's so much information that front runs prices. It's like if you have a speed limit and you know that the speed limit's going to drop, you've got to know that it's a time to slow down, or you run the risk of getting a speeding ticket. In markets, when I try to give people the framework of an institution, a hedge fund, an individual investor, an algorithm, when volatility rises, it is a loud sign: take less risk. Because if volatility is low, you're supposed to put more capital at risk because there's less risk and you need more capital to get the return you want. But if volatility is rising, you need less money to get that same expected return. And one of the challenges that people have is they're told the higher the volatility, the more the return. But unfortunately, you can get whipsawed and wiped out before you get the realization of the directional benefit of all the risk that you're taking. So I want to give people a better framework for listening to the news, watching prices, reducing the viscosity or the friction of their investment decisions so that they're just not investing with their feet in concrete blocks and say, I'm going to ignore all the news. I'm going to go, I can't hear you. I can't see you. I can't speak about you. You have to recognize your capital is the most precious thing to be able to preserve help for your family, for your community, to do charity. If you're just treating it like a casino, and when it gets riskier, you raise your bets, that's the antithesis what any institutional person would want to do. And that's why they're around and most investors get wiped out. So I'm trying to kind of move that information into a language and a framework that individual investors can take advantage of.
So let's start off with Bitcoin and what your thoughts are, what's been happening with it over the last couple of weeks. And let me back up a second before you start with that. What were your thoughts initially with crypto and Bitcoin, and has that changed with what's occurred?
No, I mean, you can go to the beginning of Bitcoin, the Genesis coin, in August of 2008, I believe, when I can't even pronounce his name, Satoshi, he created the first 50 coins. And then it was really not meaningful until February of 2009 when the first coin hit $1. Okay. But the first transaction of Bitcoin was 5,050 Bitcoin for $5.02. That's less than a tenth of a cent per coin. That is a 1 billion% rate of return. The volatility at the very beginning of Bitcoin in its formative year or two is like the Big Bang in the universe. We had a million volatility. You go to the month of June of 2009, Bitcoin went from $8 to 30. That's 3.75 times in 1 month. You annualize that, and then you divide it by the square root of the number of days in a year, which is another way of figuring out its volatility. It's a quick and dirty way to figure out its volatility. You got a 40,000 volatility for Bitcoin. And that's why everybody loved it. You could buy it in the morning, and some days it double, triple that day.
Who wouldn't love that, David? Who wouldn't love that?
As long as you didn't bet at all, right, on day one. And so people were harvesting the volatility behaviorally, not by buying an option or selling an option. They were swing trading. Really below the market, they'd get hit and hit, and then it would reverse up and they'd lighten up on the way up. And it was just harvesting enormous amounts of money. But as volatility declines, and it's one of the things, it's a very complicated concept, but if you get it, it'll explain to you why Bitcoin behaves the way it does. When Bitcoin's volatility that we now have a ticker symbol for, it's DVOL. When that declines, it's effectively mathematically creating virtual coins, virtual coin supply. So when people tell you that there's only 21 million coins, that's a true statement. But they're not telling you that the system can create virtual coins, just like matter and antimatter. They get excited into existence. If they're at the edge of a black hole, that will cause what they call Hawking radiation. It'll cause the black hole to decay. When we have Bitcoin going up 300% in 1 day, or in a month, let's say, it goes up a lot in a day, and it starts to go up slower and slower. People get more confident selling highs and buying lows. And the range of their selling and the range of the buying has been getting tighter and tighter. And then they developed the options market in Bitcoin after IBIT. And folks, I'm not inviting you to take any look into trading Bitcoin options. What I'm trying to tell you is it's a signal about its realized price movement, which has been deteriorating. And if you look, you would notice that Bitcoin volatility had been falling. Its behavior had been narrowing and narrowing and narrowing from 2009, but in 2021, it had gotten as high as 175% volatility. Equities are typically 15, 16. Okay. That's a 1% daily move. Okay. You could get 20% daily moves, but those stopped. And the more people that were looking at Bitcoin, it's like Heisenberg's principle. The more you know the position of something, the more people looking at something, the less it can move. Nobody lets a free meal get away from them. So as the volatility was coming down, the price of Bitcoin adjusted for its volatility was getting weaker and weaker. You could, maybe we'll get some charts later, but if you looked at Bitcoin in terms of the Japanese yen got cut in half from 2013 over 10 years because they had a deflation problem. Their stock market had gone to 45% of the world's stock markets in 1989, and they're 2% of the world's population. The Japanese Emperor's Palace at one point was valued at the price of California. But Japan, in order to defeat that, they flooded the world with yen. They drove their currency down by more than half. And if someone thinks Bitcoin went up on its own because it's nice and talented and sophisticated and handsome and attractive, no, a lot of that was because the Japanese flooded the world with yen and liquidity. And then if you look at us, Bitcoin volatility is coming down, even with all that Japanese yen liquidity. And it goes from 175 down to 31.41 on August 2nd of 2023. And what happens in 2023? Powell pivots from raising rates to tighten the money supply. He goes to an easing bias because Citibank is so fragile. They're about to hit the lowest level in 4 years. We had just lost Credit Suisse. It evaporated. Their alternative tier one debt or equity, let's say, alternative tier one capital, they call them the COCO bonds. It evaporated. They weren't going to let Citibank go, so they went to an easing bias. And then we started, before you know it, cutting rates from 5 3/8. And if you look today at the March of 2027 expected Fed funds rate, it's below 3%. We don't have much left to cut. If you want to contrast a real world example, when Alan Greenspan addressed the issues of long-term capital on August 17th, 1998, and then we had the Y2K issue that no serious person was worried about. It wasn't going to make the world go crazy, but it did make everyone nervous. And if everyone wanted to pull out $500 from the bank just for emergencies, what's 500 times 300 million, right? It's $150 billion. What would have happened to the banking system? Silicon Valley Bank, it would have evaporated. It'd be a run on the bank. So they put the punch bowl up and the NASDAQ rose 300% in 16 months. Nobody noticed Y2K. And then Greenspan said, I got to get this bubble out of here. It's going to distort things. He raised rates in February. He raised rates in March. The market peaks March 24th, 2000. And then he raises rates, not 25. He raised them 50 basis points on March 16th. The treasury market, the yield curve, long-term rates fell to minus 134 versus the Fed funds rate. And the NASDAQ fell 57% in 9 months and 10 days until they did the emergency cut on January 3rd of 01. And why is that important? If the Fed doesn't cut and they let the dollar rise and they reduce the value of export earnings for tech and growth, you melt the earnings down, you melt the growth rate down, and you had a compression, what we call an innovation deflation. Those dot-com stocks deflated. Counterfactual, you can make up the story that what if Greenspan did what Powell does? Powell just cuts whenever he wants. He doesn't wait for the market to go down 50%, 57%. He doesn't wait for the yield curve to invert 134 basis points. He steepened the yield curve 180 from minus 111 up to plus 68. So he's stimulating when the market's at a very high level. And a lot of you folks out there might say, well, these companies are profitable now, and they weren't during the dot-com. Well, let's go through some of the numbers. The dot-com, when Greenspan said, no mas, I got to get rid of this bubble, I got to get rid of this inflation of innovation assets, the stock market was 139% of the economy, the Buffett rule. We're 225% now. If Greenspan would have cut rates and added liquidity, the ecosystem, the innovation in dot-com would have kept on going, and these companies would have been much, much more profitable before they ultimately rolled over when they lost the liquidity that flooded these assets. They're like SAP, super absorbent polymers that can take 300 times the volume of water versus a little molecule. They put them in bags, and they put them at levees when there's a flood zone just to absorb the water. But the water leaks out. So the NASDAQ went from 2 trillion to 6 trillion on March 24th, 2000. And Greenspan let it fall by 5/6, down to 1 trillion. And if you think about it, if you would have invested at the peak, you would have gone from a 4,800 on the NASDAQ up to 25,000. The NASDAQ QQQ symbol went to 120.50 before it went to 52.17 when he did the emergency cut. And then it went all the way down to below $20, from 120 to 20. If you would have invested at the top, you'd have 5 to 6 times your money. If you invested on the bottom, you'd have 32 times your money. Nobody buys that. Nobody sells at the high. Nobody buys at the low. That's not the point. But if markets are cresting and they're getting exhausted and they're just unsupportable, you're losing the added liquidity from the policymakers, whether it's debt, whether it's deficit spending, whether it's rate cuts, whether it's currency weakening. If you start losing that, it's easier to get out on the way up and get out on the way down. Amazon fell 95% in 2 years. $100 went to a nickel. No one's selling at 100 and buying at a nickel. No one's getting 20 times the shares. But if you're starting to see, just an example, NVIDIA, it's 5 trillion, the biggest of all. It's 16% of the US economy, right? 5 trillion NVIDIA, 30 trillion economy. Relative to the world economy, it's like 5% of the world economy, 4.5% of the world economy. Cisco peaked at 1.6. If they would have cut rates, if Greenspan would have cut rates and made money more available and not deprived lenders and the ecosystem, it would have gone up. It would have kept on going up. The liquidity creates the opportunity. The liquidity creates an extension of a cyclical wavelength. Ever since we got off the gold standard in August 15, 1971, under Nixon, he took us out of Bretton Woods. We devalued the debt. We debased the dollar. Gold was 35. It went to 4,200, 4,400. Because when you debase the debt, when you debase the currency, you don't have to pay that back with the same dollars. You pay it back with worse dollars. It's very easy. And the more they introduce money out of Japan to get rid of their deflation, then the COVID spending, the COVID easing, the COVID deficits, it's an ocean of liquidity. That's not continuing at the same rate. So if you look at a price of Bitcoin, you say, well, relative to the dollar, it's gone from 1/10 of a cent up to 125,000. It's 126, but the numbers are easy to remember if you do it in rounder numbers. It went up 9 decimals. With the reservoir of liquidity out of Japan. And if you look at Bitcoin in terms of yen, it's unchanged. It's barely up since COVID. It peaked at 64, but the yen gets chopped. And In yen terms, so you're getting all this liquidity in the system, but it's ending. Powell has very little room left. He's already below 3. The last 1.5 has effectively no effect on stimulant because you're causing so much mortgage refinancing activity, and you're taking the the mortgages off of the balance sheets of banks and replacing fixed 30-year mortgages with a lot of these adjustable rates, so they're not earning as much money. And a bank takes every dollar it earns and turns it into $10 of loans. We have a transition now after the global financial crisis, which I wanted to go over later, why we won't go into a global financial crisis 2.0. We have the greatest amount of equity in stocks, the greatest amount of equity in housing. Those are shock absorbers. And now we don't have to worry about Fannie Mae and JP Morgan shutting off the valve and saying, oh, you can refinance, but I want 40%, 30% down payment. In other words, your cushion. I'm not just letting everyone out of their high mortgage. And then as the economy slowed, as inflation fell apart, we lost 7.7% of inflation in just 13 months. June of 2008, 5.6. July, a year later, negative 2.1. So that your income isn't keeping pace with your mortgage payments, so you cut back on everything: Netflix, Starbucks, Dunkin' Donuts, going out to dinners, and all those businesses laid people off. But right now we have the independent mortgage brokers, the top two, again, not advice, Rocket and United. They're 10 times the size of JP Morgan's origination. And they're messaging people every day by AI bot. Let us refinance. Let us send your money through a mortgage-backed security pass-through that Trump invented in January 3rd of 2019. That was when it was approved under his last administration, so that you could package a bunch of mortgages and send them off to an end user, and they're going to be leveraged 1 or 2 times versus a bank that has 10 times the leverage. I just want to introduce the concept of American exceptionalism. Most of Europe, international, they get 87% of all of their credit from their banks, which are levered, fragile institutions, which are very dependent on the shape of the yield curve and economic cycles. In America, we have disintermediated 75% of our lending function to private credit. And I'm not talking about the leveraged guys like KKR and Apollo. I'm talking about just traditional, you can borrow money through not using the bank for places that don't leverage up very much. And then we have independent mortgage brokers for our housing. So America's become so much more resilient than every other place in the world because we don't have the lending function dependent on the shape of the yield curve, that the Fed would cut rates, steepen the yield curve to repump out credit. It's not like that anymore. Lower rates are going to create a huge economic boom in America. We have 35 trillion of home equity. We have 14 billion at the beginning of the GFC, 8 trillion by the time that thing got worked out. And now you don't have Fannie Mae saying, I'm bankrupt, I can't lend you any money. You don't have JP Morgan saying, sorry, I'll need 30 to 40% leverage, capital, down payment, or conformity. You have to have 20%. They raised that to 30 and 40. So nobody could get money. Only the rich could get money. So now, where are we? We have a Bitcoin that sucked up all this ocean of capital as the volume of capital exploded and accelerated. And now we're in an environment where the market's calling the bluff. The Fed can only go to zero in America. Unlike places around the world, we have 7 trillion of money markets. They won't function in a negative rate environment. So Bitcoin is coming back to earth. And when you have people and they give you these charts, these 2-dimensional charts priced through time, and they say, look, we have 3 drawdowns of 80. They're not giving you the kind of charts we generate: 3-dimensional, 4-dimensional, 5-dimensional, 6-dimensional charts. It's like, yeah.
Let me ask you a question.
Yeah.
Where do you see this? If Bitcoin's coming back to Earth, when will it hit? When will it make landfall? Then, in your view?
So think about this. Bitcoin was excited into existence by Satoshi in 2008. We hit an all-time high October 6th. How many years is that? That's 17 years. That's half of a phase of a wavelength. It's like a radio wave versus a microwave. Radio waves go through walls. X-rays at your dentist, they leave the room so they don't get zapped. It's a long wave function. Volatility in Bitcoin, forget the 40,000 we spoke of in June of 2009. Forget the infinite from its excitation to existence. It was 31 before Powell started his easing program and accelerated the ocean of liquidity. So you got a bounce. Bitcoin volatility jumped from 30 to 186, started to come down. It fell 70% as it started to bring down Bitcoin. Because what happens is as volatility comes down, people are want to make money. The framework for markets are just, I'll go right back, but they produce M2. And when M2 is expanding and accelerating, it just wants to buy things. It just moves things. It moves up volatility. What happens when you slow down the growth of M2? It's hungry. It wants to eat. It'll buy a dividend. It'll buy a yield. It'll buy capital appreciation. But what happens when yields come down? What happens when dividends come down? What happens when markets move up more slowly? It's got to eat. It's not going to say, "Oh, I'm taking a timeout." No, it wants a return. So it will sell volatility. It will harvest it. That's called harvesting theta. Some people call me a theta hog because I like to sell volatility. So the system is smothering Bitcoin volatility. It's fallen 95% in 25 years. Powell cutting more than any other Fed in history when the economy is above trend, when the market's at a high, and inflation's above trend. No one's ever done that. That's novel. Never happened before. Market wasn't prepared. So you get to do it. He kept volatility high. So I just stay there sitting and eating volatility like M2, like an algorithm. Now volatility's on its down phase again. So when volatility comes down, it's causing people to want to short it because whether you're an institution or whether behaviorally you're a swing trader, swing traders smother volatility because when they don't get hit, they drop their offer. When they can't get filled on a bid, they lift their bid and they tighten the range. That's reducing realized volatility. That's reducing implied volatility. And that's what's happening. And the creation of the ETFs 200.
Still here. Still there.
And I was trying to get rid of this. Okay. So the creation of the $200 billion ETF universe made it easier for people to short volatility. There's options now. Michael Saylor at MicroStrategy, what's his business? He says, I want to, sell volatility, Well, what happens if everyone in the world is selling volatility? It's not much of a bid for volatility, right? It took a move by Powell to go to an easing bias and then start cutting so early in the cycle for Bitcoin volatility to rise. It went from 31.41 to 92.71. Now it's back at 52. It's causing virtual coins to be created. The lower volatility goes, the more people are selling virtual coin. It's a mathematical feature. When you sell volatility, you're also taking coin price exposure, virtual, it's called gamma. And so when you're selling more volatility, you're selling more of the gamma. Now you owe that, it's a liability. It's not like, oh, it's free coin, it's virtual. But as volatility keeps on coming in lower and lower and lower, more and more virtual coins will come into existence. And then your question is, well, what's the bottom? Well, when Bitcoin volatility hits its absolute low, maybe that's going to be 30, maybe that's going to be 20 like a tech stock, maybe that's going to be 12 like
12,000? 12,000?
No, I'm saying the measurement of the daily price movement of a tech stock is so like a VIX of 12, a Vixen of 20. Try to use the framework. A VIX of 16 means a 1% daily expected move. You could have the volatility go down to the level of a treasury bond, which is 7 to 8, or a currency, which is 6. So Bitcoin could go to a 6 volatility. And then it'll be down there and people say, oh, it's never going to go up. I was disappointed. And they'll be selling volatility. And they'll sell volatility. So instead of bouncing as it did in July of 23 from 32 up to 92.71, people say, oh, we don't have to worry about that. Let me just sell. So instead of going to 92.70, it'll only go to from 6 to 10. And they'll keep on smothering the volatility. And then at some point, a decade later, the volatility will be so low and Bitcoin will be creeping up because Bitcoin is more than a currency. But when you have 21 million coins and everyone trying to get into it, and you drove it up 9 decimals from a tenth of a cent to $125, and then it was 25,000 on August 2nd, or August of 2023, when they went to the easing bias. It's gone up 500% since that time, But now we've fallen 40% in a month, 5 weeks. Volatility had picked up. It's now rolling over. So we're looking at volatility leading the price. When did volatility peak? On October 6th? No, that's when Bitcoin peaked. Volatility peaked on October 18th. You have September 18th. You had a 3-week advance notice that volatility is coming down. When volatility comes down, people sell more volatility and they create more virtual coin, which then selling at the same time. And that was the supply-demand imbalance. So we just got an announcement from the Fed on October 29th, essentially no rate cuts for you. And then the next thing you know, on Friday, they said, okay, rate cut for you. So you get a little lift in volatility, you get a lift in Bitcoin. But when we take out the lows in the volatility of Bitcoin, the VIX of Bitcoin, DVOL, you'll see that lead, and then Bitcoin will get pulled down like a tractor beam. Now, if you get faster and faster rate cuts, it's going to keep this process going. But when we slow down rate cuts to only 25, and 25 no longer is adequate to neutralize the buying pressure of treasuries, and then the dollar starts lifting, you'll get the accelerated decline. So we're a seller of Bitcoin volatility. We're a seller of Bitcoin itself to a lesser degree. But the lower the volatility is, the more I'm going to be shorting Bitcoin. And it's not advice for anyone. But this doesn't apply to Bitcoin only. It applies to every asset. Treasury, NASDAQ. How about a Treasury pair? How about a NASDAQ pair? The 30-year versus the 2-year. How about NASDAQ versus S&P? And this is what I had wanted to start earlier, but we went with Bitcoin. The 2 most powerful forces in markets, the 2 focal points, where all observation needs to be maintained, is when the NASDAQ is outperforming the S&P, or when the NASDAQ is underperforming the S&P. When treasuries are outperforming mortgages, or mortgages are outperforming treasuries. Why? Because you have 70 trillion S&P, the NASDAQ is 40 trillion. It's 110 trillion. That's a powerful, number of eyes looking there. And with mortgages, it's 13 trillion inside a 50 trillion asset class. And treasuries, we know, is a 38 trillion asset class, which you could then grow by including all global Western debt, because they're all spread interchangeably with just some yield differential. So the most powerful force, the thing that's more important than anything else you can watch, is the price of the NASDAQ versus the S&P. And I have a pinned tweet on July 17th, 2024, which was 5 days after the completion of a 5,711-day rise from November 21, 2008, interestingly, the month Brad Gerstner started his career, the NASDAQ goes up 24 times straight. You got little, jiggles along the way, COVID, the tariffs, all that stuff. But it went up 24 times. The S&P went up 7.5 times. It went up 3+ times. Innovation, because they kept on pumping the money in and extending out the economic cycle. But they're not repealing economic cycles. They're just transforming them from every 4 years to longer wavelengths and much more violent drawdowns. Quicker. We lost 50% of the S&P over 130 weeks during the dot-com peak to trough. We lost that from September 15th, 2008 until March 6th of 2009, minus 55. So it's like climate. It's getting more extreme. Whether it's man-made or not, it's no question, we're having more extremes. Same thing, because there's have more policy interference. They do QE, they cut rates, they get rid of it. Everything they do is interference, whether it's cutting or hiking. And so when we saw the NASDAQ stop outperforming the S&P, when it should be outperforming it in the growth phase of the cycle, that was our signal. And it just in matrix algebra, linear transformation, it's an eigenbasis. So we flipped from the S&P being the one that does worse and the NASDAQ outperforms, cash is worse and Bitcoin outperforms, to now, if you divide everything out there, the price of everything, by Bitcoin, everything's going up like crazy. If you look at XLV, which I think on Friday, every one of the members of the low beta set was up that day, 21%, 52-week highs. And our motto is there are 4 seasons and there are 4 investing seasons: high beta, low beta, no beta, re-beta. And right now we think that the amount of policy interference, the support from governments with deficits and rate hikes and rate cuts and QE and QT and yen currency devaluation, we think that the acceleration of that is already apogeed. We're already no longer accelerating. And that's what's causing the failure of the NASDAQ to accelerate with respect to the S&P. It's the most important data point for us. And so it started to roll over in 2024. And you might remember we had that 3-week contraction, the compression, where the Nikkei fell 22.5% in 3 days in late August. And you had that gap down of 6% on the NASDAQ 100. And then Austin Goolsby's out there and saying, oh, no rate cuts, because they wanted treasury prices, which had been rising, to fall. Because the framework that people should have is Lloyd Blankfein from Goldman Sachs, who ran a fixed income group over there before he was put on the top, would always say, in a year after the market has a problem, and I ask you, where was the leverage that unwound to cause this problem? Where are you seeing the leverage? Because unwinding leverage, margin calls are involuntary, and they can cascade and they can snowball. And so that's what we do. We look at every price with respect to every other price. An interesting trade pair would yeah.
Okay, you're throwing a lot of information out of me here. So let me ask a couple questions. One, I want to just go back to Bitcoin for a second and then move on. But what do you think then the future of Bitcoin and the crypto markets are as they sit today? And you said volatility and lack of liquidity, if I'm understanding you correctly here.
Yes.
How much farther do you think it's going to go down in terms of dollar? And I'm not asking for a specific number, but
can I go in terms of decimals? Because it's alarming when you say the dollar amount. So we rose by 9 decimals. So the base case is 2 decimals. It could go 1 decimal down to 12,600. 12,600. It could go to 1,260. It could go to 126 as volatility is imploding. And then the volatility of volatility implodes. And then it acts like a currency. But it's not. It's more than a currency. And so you'll just have people layering and layering leverage on Bitcoin. They'll say it's never going up. They will have lost faith. And they'll sell the options. They'll sell the calls against. They'll sell it for nothing. They'll sell it for like free because they said it's not real, and it is real. And then someday, whether it's in the 2030s or the late 2030s, early or late, you'll get a super excitation, and Bitcoin will just start melting up, and it'll just go up 4 decimals or 5 decimals to 10 million. I mean, we have a $120 trillion, $110 trillion global economy. Of course, they're going to debase that down to a quadrillion, right? Over time, right? So if you have a quadrillion of money, what's the big deal if 1% of that's 10 trillion? What's 10 trillion? That's 500,000 Bitcoin. What if it's 10%? It's 5 million Bitcoin. What if it's 20? Right? So Bitcoin has a powerful role. Some people say, oh, you're going to have quantum, hacks. Okay. The first quantum hack that succeeds, there'll be a fix for it. Okay. These are smart people. Okay. Plus, most people say the only coins that are vulnerable are the original ones still on the chain, not removed to triple kind of redundancy, biometric and this. So I'm not worried about Bitcoin being innovated away, because if it is, we'll all know. It'll be clear. It'll be obvious. You can see it in the price. It'll be on the news. So that's not a fear that I have. I just feel that we had the greatest increase in liquidity from the Japan deflation of their currency, 75 down to 161. And then all the COVID spending globally, no regard. And then the Biden spending on top of that. And then Powell cutting rates when the market's at a high. Greenspan cut after .com when it was down 57%. What's this guy cutting when it's at a high? He's using up his arsenal. So I think that liquidity is going to get leached away. Volatility is going to get leached away. Leverage is going to get leached away. And then leverage is going to be piling on. People shorting the volatility, saying, I'm making free money. They're going to say, this Bitcoin's never going anywhere. I'm selling calls. And then one day they'll be short 100 million virtual coins. And how do you get that back? Well, you got to take it up to 10 million. So I'm a big believer in Bitcoin. I believe in price. I believe in what I'm seeing. I'm seeing volatility fall at such a rate, signaling the lack of liquidity. And so if you don't have Bitcoin, just from the technical analysis, close the end of the year above 105, because last quarter was a very narrow range, the tightest ever, 105 to 115. We went to a new high. You close below 105, that's a bearish engulfing candle. That for some means we'll have selling pressure for 9 months. If we close somehow below 74, that would be a 1-year bearish engulfing candle. We had neither of them ever in the history of Bitcoin. It's selling pressure. And the lower it goes, the lower the volatility. The lower the volatility, the lower it goes. And people lose faith. But it's a 17-year just for a quarter cycle. The spring season. Now we have to go through a maturation phase. And then we'll have the desiccation phase, losing of the leaves, but the innovators who are using that as the plumbing of the future, which is unbelievable what it represents. I mean, if you've ever tried to clear a swap in a strained environment, you'll be grateful when it's on blockchain and not on someone's balance sheet at a bank or another asset where someone is nervous about it and then they back away and the system deleverages. So it's going to add tremendous resilience to the system. It's just price has to reflect reality. And we're losing the oceans of reservoirs of liquidity. So if you divide Bitcoin by the Japanese yen, if you divide Bitcoin by the residual of the potential additional rate cuts, 5 3/8, it's already below 3 if you look to, March of 27. So I just want people to know that when they say down 80, that's 80%. That's down 0.8 of a decimal. But every one of those occurred in a wave of accelerating liquidity being introduced by policymakers out of, let's say, Japan, Trump, Powell, Biden, Powell again. So that's the framework. So if you take the entanglement, like our main chart, which describes everything, the focal point of NASDAQ outperforming S&P, the focal point of treasuries outperforming mortgages, and you see it's causing movement in the dollar, movement in the euro, causing the yield curve to change its angle, which has a direct effect on the sectors you want to have ownership in, because a flattening curve is dollar supportive, because the US benefits from lower rates more than every other country in the world because we have the prepayable mortgage and they're getting all their credit from the bank. So they need it steeper. So as our rates flatten, we'll flatten the globe and they'll be cutting their rates, lowering their policy rate. And that differential between us and them is dollar supportive. We rose 15 months after the dot-com. We're down, but now we're coming up. And a lot of people bought a lot of goods overseas before the tariffs were announced in April, and that was part of the administration's plan. Let everyone front run those tariffs. Let everyone plow an ocean of dollars all over the world. Let everybody get short. Let everyone come up with a reason why it's a new normal, that the BRICS are in charge and the dollar is done, it's debased, goodbye. They trap people. Now, where's the dollar? It's above its 50, it's above its 200. It's less than 1 cent from a golden cross. It touched its 50-week moving average on last week. And so as the dollar goes up, and it had followed an ellipse pattern, which is a powerful acceleration with friction. It's not a circle. It's been trying to go up, but policymakers have been suppressing it. Now it's going up, and that is not good for risk assets because tech and S&P are exporters, and Main Street are importers. And this is what we spoke about before. I have never been more optimistic about Main Street. Main Street isn't going to have like a small little period of good time. It's not a K economy. It's going to be a special K economy. Main Street is going to have lower mortgage rates than they could ever possibly imagine for a longer period of time. It is going to drive down the unemployment rate to levels we haven't seen ever. It's going to raise wages. When you think about NVIDIA, the company, every employee at NVIDIA, there's a market cap attached to every one of their 40,000 employees. It's $125 million per employee. What does $125 million buy you in housing? 675 homes at $200,000. You don't need diner visits and HVAC visits and plumbing and electrical and Home Depot visits to make 675 homes and you're replacing one job? As we transition from the deflation of innovation, from the deflation of policy interference, as we revert back to the Greenspan approach, as we revert back to the consequence of Huber's approach, where you had the 48% decline in 71 days, September 3rd, 1929. The chambers are empty, folks. The arsenal is empty. The rate of growth of support for the market is decaying. So while you're watching these great tech companies, you're not noticing that biotech's at an all-time high nearly. Healthcare is doing well. And if you price these other assets, we call it mush. Mortgages, utilities, staples, and healthcare will eventually go to Bush once treasuries start to accelerate versus mortgages. But for now, look at these four sectors. I'm not telling you what to do. I'm not giving you advice. But if you look at them and you measure them as the numerator and use Bitcoin as the denominator, these are destroying Bitcoin on a return basis. People's framing, Bitcoin made so much money for the early adopters, it's got to make money for me. And this is when we spoke about, last point, my charting, multiple dimensions, not 2D chess, 3D chess, 4D chess, 5D chess, many more dimensions. If you look at Bitcoin with respect to its market cap, is it easier to move Bitcoin when it goes from 1 billion to 2 billion or from 1 trillion to 2 trillion? How much more liquidity did it take? That's why it's more sluggish. If you take a look at the level of policy interference and the potential residual policy interference, the support of easy money and a deficit spending, you'll see that Bitcoin is getting exhausted. If you compare Bitcoin with respect to treasuries or with respect to cash, and then you denominate that on Lily's outperformance of Novo Nordisk, that's below the 200-week moving average. You're having things accelerate versus other things. Lily's at an all-time high, Novo Nordisk's at a 4-year low. What if some of your money, instead of leaving it in Bitcoin, you put it in some other things that are working, that are deep and liquid? Everyone is too hodl, like, we have a guarantee. I'm allowed to go down 80%, and then I'm told it has to go to a new high of multiple orders. And look, we're at 68,000. 64,000 in 2001. We're 126. 2001, 64. We're at 80 the other day. Over 4 years, the thing is up 25%. Healthcare did that in 3 months. We have to look at everything with respect to everything in every time frame, in every derivative. If you take Bitcoin, divide it by its volatility, and you use that as a numerator, that pair, over Lilly divided by Novo Nordisk, that is below its 200-week moving average and slicing right lower. But if you look at Bitcoin with respect to Bitcoin, with respect to time, and you don't do any kind of, vet, vector analysis, then your lens, you're wearing, what do they call them? Blinders. I want you to watch everything. Don't do what I say, but if you see something that's doing better than what you have, can't you loan 1% of your money to it? 5% of your money? Like a baseball player who's striking out too much, you put him on the bench. A basketball player not getting the free throws, partying at night, give him some bench time. How about giving some bench time to some exhausted old heavyweights and give it to some of the youngsters that are really running? And that's why we think that comp tech and discretionary, or rather common tech, and then the biggest two discretionary, the Amazon and whatever. I don't like to mention Tesla because I don't want to be blocked on the X platform. But if you look at utility staples in healthcare, are they moving up faster than what you have? Can you just put the ticker symbol on? Can you put the symbol BTC and DVOL on your screen to see that DVOL is the primary trend and Bitcoin is the puppy that's being dragged along? And if you can do a partial derivative with respect to policy, whether you strip out for Powell cutting when he said he wasn't, what happens if Bitcoin takes out 74,000 and Michael Saylor is sitting on 700,000 coins and a big liability coming up? Will the board ask to remove him? MicroStrategy on March 10th, 2000 declined 90.8% over 38 days. That's almost 91%. Just keep that in mind. It can happen to MicroStrategy. If Bitcoin falls, he has no choice. Yeah.
So let's go back. Let's move ahead from Bitcoin, because you're saying in regards to companies like Nvidia, and correct me here if I'm misunderstanding you, but you're optimistic of what's going on with Nvidia. Am I hearing that correctly?
Well, what I'm saying is Nvidia looking backwards was amazing. But at 5 trillion, I just completed my 9th marathon and I had to walk because I put on too much weight and I didn't want to break something. A fat man can't do a marathon. Nvidia is a fat man. X-rays can't go through a wall. AM radio has a 550-foot wavelength. That means an arc degree is only 5 feet. It goes right through your wall. You can listen to AM radio in your house right through a brick wall. Nvidia at 5 trillion at 16% of the economy. What's it going to do? Go 32% of the economy? How about some other things? We know that the difference between a potato chip and a computer chip is electricity, right? Without electricity, what's the difference? Has no utility. We don't have enough electricity. Now, I didn't even discuss passive investing, which is so critical. Passive investing is the biggest distortion of price that's ever happened.
Let me chime in here for a second. For passive investing, would a fair comparison?
401k auto investment. 401k auto investment.
And people that are, say, young people that are jumping in and Robinhood, and is that all under the
No,
passive?
no, that's not passive investing. Just you've got all this money that's going into the market through the 401k plans. A lot of it's just going into the S&P 500 because that's what people say. And it's overloading the biggest companies. They just get a bigger and bigger and bigger and bigger share of the money. And there's not enough stock. But eventually, gravity attaches and it reverses and goes the other direction. So whereas I talk about high beta, low beta, no beta, rebeta, where you're going to go from the tech and the communications, then we're moving to mortgages, utility staples, and healthcare. And then we expect those to not do well, utility staples and healthcare, when treasuries are doing well because we have deflation from many, many factors. So you're going to want to have more of your money in treasuries. And then that sets up for the greatest bull market of all time because you have very, very low rates. We think we're going to evolve into a private credit formation of credit, not just U.S. treasuries as the base collateral. World War I, we used gold and did fractional gold for lending. Then we had the Eurodollar system in World War II. Then Nixon put us onto the dollar, the U.S. Treasury as collateral. The problem with U.S. Treasury as collateral, you run out of them. Reagan had a 5% deficit and Clinton had a 3% surplus. We ran out of collateral. The world economy grew, and it was a Garrett. It was a strangulation. Greenspan warned him, please, Mr. President, you can't run that kind of surplus. The plumbing will not work. We ran out, and that created the global financial crisis in part. The shortage of treasury collateral slowed down the world economy. If we convert our mortgage-backed security mechanism using agents to send packages of assets stepped up by the government as a no-risk underlying asset, just a yield price adjustment, put it in pensions, 401ks. If we do that with private credit, we'll have an endless supply of credit to expand the economy. That's why I say we're not going to go up 24 times. I think we go up 100 times. I think Bitcoin could go to 10 million. But we don't have enough collateral in the system. We're running out. The plumbing is breaking right now as we speak. You could just see it. To me, it's a freight train. I mean, I don't know how it doesn't lead every single broadcast. Everyone thought that the dollar is supposed to go down when yields go down, right? Because it's lower yields than Europe. That's what's on the mindset. Well, what's happening to treasury prices on the short end? They're just going up in price. They're melting up in price. They're going up in price, and it means anyone who borrowed them to buy FANG is having a higher collateral problem. And as those go up, and now we got rid of QT, that's $1 trillion less supply into the market because the government's going to be recycling $1 trillion more roll-off than they did in June of 2024. That's $1 trillion less available collateral for the globe. And we have a 5% nominal globe expansion, and we have a contraction of the growth of collateral. And when they cut rates to zero, which everybody imagines they'll have to, you lose $400 billion of deficit from 3 7/8 down to zero, just on T-bills alone. That takes the deficit today from 5.8, 272, primary deficit 308. Interest expense will drop by 400 billion. That takes us down to 175. The deficit's going away, folks. The same would have happened with Vice President Harris. It's nothing to do with what the president or the vice president would have done if she was president. The system has gone populist. We're not accommodating huge deficits. And so we're running out of collateral. The system is going to buckle, and it's going to involuntarily delever everything. And so when you have all this liquidity that pumped in, and you drove the NASDAQ up versus the S&P 24 times, and it stopped on July 10th, 2017, and 2 days later, that was my signal. And then I put my post, capital flow, high beta to low beta. Along the way, we got rate cuts that never happened in the past. So you stay more in your selling volatility structure. But now we were on Friday at the same level we were in July 10th, 2024, which led to that big rollover, the 3-week rollover. Same level of NASDAQ with respect to the S&P. And what the problem with that, when that deteriorates, is there's enormous derivative structure that is making money harvesting. Effectively, it's like they're selling NASDAQ puts against S&P calls, and they're just making the money on the extra premium. The problem is that trade is going bad. It's a leveraged trade. People have the S&P 7, the Mag 7, and they're underweighting or short selling the 493 or the Russell 4,993. What happens when the Mag 7 underperforms the S&P 493? What happens? That's leverage, that's unwinding, and it accelerates. Now, policymakers can cut their residual stock of policy support, but it's only a policy, it's only a temporary thing. You run out of other people's money. Greenspan did it on purpose because he knew he made an AI inflation or an AI bubble or a dot-com bubble. It's all the same, an innovation bubble, to distract people from the dot-com turnover. Everyone watching one point in time and everyone being worried at the same time. There's too much knowledge of position, no momentum. The banks would have a run. This guy, he's cutting. There's nothing left. So we think below 3% on the Fed funds, they have to accelerate to 50 basis points a meeting, or the yield curve will flatten, and you'll cause mortgage activity to pick up so much, it'll speed up the decline of rates. And that makes the dollar go up, because when you shorten the average life of a mortgage by going from a fixed rate to only a variable rate, that means you're only buying hedging for the first part of the mortgage, the 5-year, 7-year, 10-year, where it's fixed, and then the rest of the time you're not buying any hedging. You're depriving the bank of that income, the banking system. I mean, a lot of the income is going to other participants, but the banking system. So why I don't like Michael Saylor's company and why I don't like the banks as an investment is because there's a lot of money in the banking system and there'll be less money to earn. Because the whole mortgage structure, they're losing market share to independent mortgage brokers, and will become a duckbill platypus. It will become extinct, these fixed rate mortgages, in favor of the lower amount of volatility or yield or theta in mortgages. It's just less supply. And then the total duration value of the outstanding mortgages, which right now, let's say it's 6-year average life, 12.5 trillion, 75 trillion duration years. You could normalize that to a 10-year treasury note. That's like 7.5 trillion 10-year treasury notes. If you lose a year of average life because rates fall and more people prepay, you got to come up with $1.5 trillion worth of assets. You got to buy the treasuries. You drive that down even more. And so the most important thing you have to follow that you can do that you're not doing now is you've got to put Mortgage News Daily on your homepage. You've got to make sure you look every Wednesday at the Mortgage Bankers Association. You can see it either Diane Olick on CNBC, typically on Mortgage News Daily, or just go on their website. We were 157% year-over-year refinancing 2 weeks ago, 147 a week ago. This past week, we were down to 125. Purchase was 26% year over year. Look at mortgage rates. I mean, look at mortgage rates. They're down again. The 10-year, where's the 10-year? Back at 405. So as rates go lower and prepayment speeds pick up, you're shrinking the average life. And that's only going to make mortgage rates go down and the affordability improve. And I want everyone to disabuse themselves. And this is one of the kinds of things we do. People think there's something that's durable and true, that mortgage coupon latency is a real thing, that if you've got a 3.5% mortgage, a 4% mortgage, that you're not moving. That is not true. You're not moving until a time. Now, obviously, death, divorce, work from home, you're moving. But if you're looking on Zillow, and most everyone's looking on Zillow, and housing went up 0.5% last quarter, if housing starts to pick up speed higher as mortgage rates go lower at a faster rate, you're going to say to yourself, honey, the house went up 1% last quarter. That's 4% a year. Now it's going up 5% a year. What are we doing sticking with this extra mortgage? Let's go there. We'll refinance later. We won't have any house to move to. Coupon latency is only under stable pricing and stable rates. When you get the housing, which is at an all-time high, and you don't have the GFC friction of, oh, come with 30% down payment, come with 40% down payment. I'm Fannie Mae, no mas, I'm bankrupt. We now have 30% in Rocket and United. And then what happens? The big banks are being more honest. They're not log jamming you saying, I'll get back to you in a month. I'll rehire my bankers. Mortgage rates are going to fall faster. We're at 6.11 on the 30-year fixed on September 18th, 2024. When JP Morgan came out after mortgage rates fell 192 basis points in just 10 and a half months, 10 and three-quarter months. And they said, we're losing our net interest margin. And the Fed went from signaling through Loretta Mester on CNBC a 25 basis point cut. The next day, after JP Morgan came out with that statement, she signaled, oh no, let's go 50. The yield mortgage rates went up 115 basis points in 4 months and 4 days. The 10-year Treasury, they went up 129 basis points on our spaces, on our podcast. We're saying in August and September, they needed to cut more than expected. There's a non-zero chance of an intermediate cut if they only did 25. They got to get these rates up, or mortgage rates would go from 6.11 to 4.5 in 3 or 4 months. That's just the way the mortgage market is, very, very model driven. Because there's no supply, rates were just coming down.
So, okay. Talking about mortgages, and so do you expect the Fed to cut or raise rates?
They have to cut. They have to cut.
So December they're going to cut.
They have to cut. If they don't, the dollar will just melt up and tech will get hit. They got to cut. They got to cut 25, 25, 25, and by May, 25 or 50. Because the 2-year yield, the 3-year yield just keeps on melting up.
So what's the fallout going to be from what's the impact going to be for ordinary people when the Fed makes these cuts?
So if you remember how frustrating it was for people, I had a meeting with a private credit guy. He said, we had our paperwork in. We're just about to be approved. It was like 6.11, and the next thing you know, we couldn't refinance. So we called for a major steepening of the yield curve on the initial phase of the rate cuts in 2024 before they even did the cuts. Before this cycle, we said it'll be a very anemic rise. And the catalyst for that forecast is that when you have an inverted yield curve, nobody's going from a fixed rate to a floating rate, right? There's no advantage. We have a range from 30 to 70 basis point advantage. People go fixed to floating. Problem is, if you both have people shifting from fixed to floating, which is what's neutralizing the rate cut. So the rate cut causes M2 growth, but the refinancing neutralizes and causes M2 death. Okay. When you go steep and lower, that's when the adjustable rates have a clearing rate that people can really qualify for. You know, all the applications are in. A lot of people are getting rejected. They're just waiting on the rate. It's not like, oh, we'll get around to it. No, the paperwork's in. They're just waiting for the rate to clear. The decision's already made. That money's spent. When we start going below 550 on the adjustable rate, which will be caused by rate cuts, you'll grab such a level of shift. We're at 40% in GFC adjustable rate. We're at 7. We got to 11. 7 change now. As that picks up, that causes a flattening that they have to stop. So the adjustable rate is the gateway mortgage. The refinancing flattens the curve. It starts to bring a whole ecosystem of higher housing prices, and that volatility kind of accelerates, excites, warms up the sluggishness. It brings entropy to the latency of people. We got to keep our 4% mortgage. No, that's anyone with a 4 to 5. They'll say, no, prices are going up too fast. We got to go. So we're expecting sometime next year mortgage rates to be in the low 4s, and by the year after, in the mid 3s or low 3s.
So rates will go down, housing prices will go up.
Yeah.
Demand will go up from that, is what you're saying.
Yes, but the yield or the mortgage rate will decline faster than the price goes up. And so the affordability index will improve dramatically. And rents will go down outside of Manhattan.
Okay, so demand will go up, but you have an employment issue as well, right? I mean,
yeah, it's going to collapse. Employment's going to collapse. Unemployment is going to collapse. You have one person that could be fired at NVIDIA and free up $125 million, and that makes 675 homes. Do you know what the labor intensity of housing is versus the AI, where you got one guy with a $10 billion data center for chips that are made in Taiwan, as opposed to the labor of building a house and framing it, and plumbing it? And there's no AI chatbot doing an AI a framing. And now you do have some prefabbed homes, okay, but our labor intensity is going to grow, and we're going to have wage gains, and that's not going to be inflationary because it'll be neutralized by the deflation of AI and the strong dollar. It's going to be a golden age. It's going to be the greatest American golden age. And I am a Democrat. I want to make it clear. I'm not drinking the Kool-Aid. I'm just looking at the numbers. Mortgage behavior is extremely model driven. There's no hedging from what I can gather from my contacts. Nobody's concerned about lower rates. That's an opportunity. No one's model has that. All the hedge funds, all the mortgage guys, all the leverage people. And the only thing that's been delaying this is Powell taking a novel approach that Greenspan didn't. So let's go back to Greenspan. 2000, stock market, 6 trillion up from 2 trillion. It falls 83.6% from 2000, March 24th, November 8th, 2002. What do you think the 2002 year was for housing in an environment where the stock market, the NASDAQ fell 83.6? What would you think, without even looking, what would you think was that year in housing? With all that deflation of .com. What's your instinct tell you?
I couldn't even throw a number out there.
No, but would you think it would be better or worse for housing?
Oh, I would think it'd be...
If you lost 83% on the NASDAQ. 80.
Oh, I think it'd be worse.
It was the greatest year of housing ever. Ever.
Because it was so
by
cheap?
More than 50. No, because AI was... I don't want to use the phrase that you use when a guy's trying to block you from talking to a woman at a bar. But AI was blocking capital, was diverting capital from housing. And it was not profitable. It could be profitable a little, it could be profitable for now, but there was enormous write-offs. Lucent evaporated, Sun Microsystems evaporated, Nortel, the 9th largest stock in the world. It was 50% of the Toronto Stock Exchange, direct listing of 33, and Bell Canada Enterprises, 17%. AI is destroying Main Street, and Main Street's revenge is at hand, because Sam Altman saying, I'm doing $1.5 trillion worth of contracts with $13 billion, 1%, not even, of revenue that cost $50 billion to generate or whatever. That hopium, that Bitcoin, super liquidity absorbing price is going to leak that capital into mortgages. And that's our main framework model, the tension. The push me, pull you from Dr. Seuss, Dr. Doolittle, excuse me, two opposing llama heads. The one is equity risk premium down, that's NASDAQ leading the S&P. And in the other direction, you have treasuries running up faster than mortgages and pulling those mortgage rates down. And if it wasn't for Powell, if Powell was Biden, we'd already have 3% mortgages right now. The dollar would be through the roof. tech would have gotten smashed, Bitcoin would have been below 10,000, and everyone would be talking about housing. Everyone would be, not on Robinhood, they'd be on Zillow. And we have the least amount of debt in housing since the 1950s. When is the last time you had a 75-year low of leverage and Wall Street didn't find a way to put on some leverage and make some money? Never. So we're going to get equity going in there. We're going to get debt going in there. We're going to get appreciation going in there. And we're going to get labor intensity going in there. There won't be a seat at a diner anywhere near a construction site. And you can see it in the beating on the construction data in last week's reports. When you see prepayment speeds pick up, when you see 26% above last year in new and purchases, when you see 113 basis point lower adjustable rate than the prior year, there's no friction here. So in math, there's something called shear stress. You have a box, and then it's windy, and then it like tilts. You could measure that angle. That angle's called theta, and the deformation is a tangent. We have stress. The mortgage market wants to run. The treasuries want to run. Powell keeps on sending them backwards by pumping up AI and innovation, and it's not working anymore. Microsoft, Nvidia, Amazon yesterday was 13% above the 2020 high. That's not a lot. That's one bad month, and you got no alpha over 5 months. Bitcoin in yen, no alpha. But people are just looking backwards. I drive through the front window. I look through the front window. I look at my mirrors, and I look at the rearview mirror. But I do most of my time looking forward. Okay, I'm not Jason Statham driving backwards in Transporter. Okay, but the policy interference we've experienced in this easing cycle is novel. That's why backtesting doesn't work. If you're not using residual policy potential versus kinetic, what we've already done, you have to denominate everything. 5 3/8. We've moved ourselves to 2.93, right? You've got to use that. And then what happens when we're at another cut priced in on the deferred cuts? Then you've gotten half of it. And the bottom 100 basis points doesn't do anything. All that does is bring in leverage, people buying treasuries on margin because there's no funding cost. So I want people to look at things in terms of tension, high beta, low beta, then low beta, no beta, then no beta, re-beta. Because I call it 1,000 days of deleveraging. Bitcoin to me is like a baklava. All these people with leverage, it's nice and soft as you bake it, but more heat, more energy, it gets crispy, you step on it, it's gone. It loses its amplitude. When you have Bitcoin leading every risk asset lower, that's very organized. It led every risk asset up. And as we were discussing on our spaces on April 21 of this year, when we had what we call a negative divergence on policy, that Trump's spokeswoman said when Trump called Powell a loser, he wasn't amplifying his attacks. We said, that's it, all in. Volatility is going to melt in tech, and market's going to surge for FANG. And then in June, we had that for Treasury volatility. And then we got our signals on Bitcoin because Bitcoin volatility fell too much. Bitcoin volatility fell 70%. And these people are still buying the coin, except as Bitcoin volatility falls, it creates more virtual supply. So if you look in one frame, everything looked good, but there's a storm ahead. There's a supply glut coming. Look at oil, my friend. Look at oil. It's a 58-month low. It's 50 cents this morning from the lowest weekly close in 58 months. Do you know what my colleagues in financial oil, which is 50 times the size of physical oil, they'll just short the heck out of oil and they'll buy treasuries, knowing that when oil breaks $10, it affects the data, it affects food prices, it'll cause the Fed to cut more and lower their funding cost for their much larger position in treasuries. And oil is the largest part of commodity trading advisors' accounts. It's more than 10 times gold, which is the second largest. And nobody's got 10% oil and 10% gold. That's too overweight. You've got to have some proportion. You drive down oil below $50, you're going to have a lot of redemptions coming out of the commodity trading advisors. What are they going to sell? Going to sell oil, going to sell gold. They're going to sell their commodities. And what that's going to do? They're going to buy dollars. And what's that going to do to tech stock? So everything is connected to everything else. In every time field, in every risk, it's called a risk field, and then every dimension. So that's why I don't mind shorting a volatility against an underlying. I don't mind shorting a skew or buying a skew against an underlying. I want to buy something going up. I want to sell something going down. That's it. I just don't limit myself to what used to work. I limit myself to what seems to be working and give it a chance to try to work more. When you have biotech, which is the number one beneficiary of large language models, in my opinion, and it's near an all-time high, do I want to buy NVIDIA at $5 trillion? I'm not sure. And if you look at XBI or IBB denominated in NVIDIA, it's showing that XBI and IBB are going up a lot faster. I like speed. I don't like sluggishness. So that's kind of the framework. I'm from the camp. I'm an evangelist for the camp of what's working now.
We're going to have you come back here and talk more about this as these things unfold.
We'll be happy to. It'll be very constructive doing that.
Where can people find you, David?
So the firm is QAge LLC. It's www.qage.net. I have a team of 5 people running the back office and the charting. We're on the X platform. You could search at Levenson_David, or the Physics of Finance, my earliest podcast series, where we equated the principles of quantum physics as well as classical physics with market dynamics. My favorite one is force equals mass times acceleration in Newtonian physics. Let's replace force with liquidity and mass for market cap, and then divide both sides by mass. So the amount of liquidity is a ratio to the market cap, and that equals acceleration. So if you want something going up, you got to put more liquidity in if you have a bigger asset. That's why I say it's a lot tougher to take Bitcoin from 1 trillion to 2 trillion than from 1 billion to 2 billion, or 10 million to 20 million. And so when things gain mass and attention and eyes, it slows down the momentum. And I like to short slowing momentum, and I like to buy rising momentum. So that was that. And it was I have a podcast series on Apple and Spotify that has no charge. It's called Polarity Radio with David Levenson. We're focused on polarity shifts. And so we think we're in a polarity shift where the market's going from constant lowering of the equity risk premium to a rise of the equity risk premium. And we think we're going to go high beta, low beta, no beta, and all the way back to when I'm the most bullish person in the world. But we have a deleveraging reset. I've got the nom de plume of D-Lev. Okay, it's my name, and it's my nickname was Lev, but D-Lev. And I can hardly wait for 600 more days when I can have my nom de guerre, go to war, when I go Relev. I want to be Relev, the nom de guerre, because it's going to be the greatest time of all time. We just want people to learn how to trade, how to invest in this time frame, singles and doubles, bunts, so that when you get the next NVIDIAs, the next Bitcoins of the next cycle, we know where we're going to find them on the 52-week high list, not the 52-week low list. So that's how you can reach me. You can DM me if someone's interested. We're doing research. We advise mutual funds. We'll advise hedge funds. And now I'm having a meeting later today. Somebody wants to put money directly under management. A large sum. So I'm delighted to come back. I trying to make it more um, coherent for people. I've been working on that for a while. My charts explain themselves much better than I do. We're going
All
to
right.
make
No, I was gonna say,
animated motion.
I think you did a good job, and and you're so going to do animated motion then too going
Yeah,
forward.
because if you see something move and you don't see the punchline, it takes more of it. If you start to see Bitcoin squiggling up like the line, but then you start to see it rolling over with respect to other prices, you say, wait a sec, why am I stuck in something that was yesterday's why do I want to be someone's exit? Why don't I want someone to be my entry? We're the church, the camp of what's working now. And for all of you, we run a morning subscription based squawk where I discuss what I think is likely to happen in the markets. Nothing is advice to transact without being a client relationship. The subscription is not that, but it's invaluable information. I think it's infinitely mispriced. And you'll get more knowledge and experience for all the mistakes I've made in my life in markets, all the experience. I've caught all the major turns, but I spent more time being early than late. And now we're much closer to the turning point, the polarity shift, because we're incorporating not just equity, but I'm incorporating mortgages, which are a short volatility product like equity. They're additive, and then we're using derivatives as another signal. And my last point is Sander Gerber of Hudson Bay was interviewed by Barry Ritholtz on May 2nd. Masters in business. Don't want to, cut you, but um, interfere. But it's a great episode. The takeaway from that episode is they say 94% of market returns can be attributable to the sectors you're in and the market. And the one thing that I just don't understand, and brilliant guy, Sander, started in the options exchange in Philly, is that the sectors are the market. So why don't you just say 94% is the sectors? What's the market if you get the sectors right? Long, short, up, down, in, out. That's your 94. And then the other part is I look at the shape of the yield curve as driving the sectors. So if you know how the yield curve is going to behave, then you'll know what the sectors are going to behave. Just like the wings on a plane. The faster, the hare, which is Comtech discretionary, winning 85% of the time, and the tortoise, which is Staples Healthcare Utility. And if you cannot blow up in the deflation of innovation positions, you'll be so strong for the next wave. And one thing we're going to tease out is it's possible because passive investing arrived in the last 20 years on its level. You may start to see the ocean of money in Bitcoin and tech going into low beta, causing them to act like high beta because of just the sheer volume and have them behave not 45% better than. So in 2000, XLP Staples went up 45%, while the Nasdaq fell 45. $100 went to 145, 100 went to 55. That's a great differential. But what if instead of going up 45, what if all that passive money going into Staples now makes it go up 100, 150, 200 because of the ocean and the speed and the Silicon Valley Bank effect? Everyone's trading on their phone if they're so it's so exciting what's going to be happening. We just have to make sure to look through the front windshield as well as the back windshield.
David, I look forward to our next conversation, continuing to follow your work, and I appreciate you taking the time.
It's been my pleasure, and it's so exciting to share these insights I hope people find and incorporate that in the discussions and the framework with the people that they consult with in decision making so that we are not someone's exit. Don't be somebody's exit.
Mike
Good
drop.
day.
Mic drop.